Hey guys, Doug the Retirement Guy. We got a new review here of Ares Capital Corporation, the common stock, ARCC. Is it good for a retirement account? This actually came from one of our viewers, wanted us to look into it. Dividend 9.64%. You know what? If someone puts something down in the comments, wants us to look into it, if you're supporting the channel, we're going to support you and we'll look it up for you. So don't be afraid to hit that subscribe button. Leave your comments. Definitely give us a thumbs up if you can. Let's get into today's video. ARCC is Ares Capital Corporation common stock. This is a BDC. If you don't know what that is, it's a business development company. Think of it as a bank for larger companies, mid-market companies that just need special financing in different ways. Typically, they are ones who do a large payouts and large portions of their net investments incomes as dividends. So BDCs, for financial and for tax reasons, has a very high distribution rate because of the rewards that they get. You'll take a look at ARCC, has a 9.67% distribution return, which also gives them a 9.64 30-day SEC yield because they have to continuously pay this out. There are no fees to talk about. Now let's get into ARC's highlights. This is the one I love the best. Is 59.9% of their loans are first lien loans, which means no matter what happens, they are the very first person in line to get their money to get payback. They are well balanced over industries, and you can see on the side from software at 24%, healthcare at 12%, commercial professional services at 9%, insurances at 5.9%. So it's a well balanced pinwheel that there's not a lot that, any one particular area, if it starts to fail, that they're stuck with. But if you look on the other side, their first lien holders of senior secured loans, 59% or 56%, excuse me, is eating up most of their money, which is awesome because that is safety. So why ARCC? Well, first off, that 9.67% return rate, which is very interesting and higher than what most people are intending for, plus a 9.64 30-day SEC yield. So the 9.67 is very common in this BDC. Actually, it's a touch low for many BDCs. But because they are primary, they are not getting as high interest rates as possible, but they're a steady flow. And then again, it's regular flow income, gives you that 30 days. But look at the performance over the S&P 500, which is what got me excited about this fund right off the bat. ARCC is down 6.9 cents when the S&P is down 8.8. 1 year, they're almost double what the S&P was. 3 years, they're 4% better. 5 years, again, almost 50% higher. So they're constantly outperforming the GSPC of the S&P 500. So they are producing what you want, and that is regular, steady returns. And the thing that got me so far this year to date, even with the drop-offs that we're seeing, they're still able to hold their own and continue and not lose as much as others. This is the next one that got me, is their PE ratio is 8.16, which is low compared to BDC industry as 17.2. So this thing is trading at a lower value than what most BDC companies are. That rings me a bell saying, hold on, we have a low PE, which means 8 times their earnings. You have outdoing the S&P 500. This is a win-win situation that I can see coming up. The question is, where's the downfall? They offer quarterly dividend payouts. And when I say quarterly, you know what? We've built another part of our retirement fund for quarterlies to spread them out to kind of improve over certain months. So I can't look bad at it. I always love monthlies, but quarterlies are always acceptable. So the return of ARCC, the market right now, the first 1 month, they're down 6.44%. It's acceptable because most of the markets are way down anyways. 6 month, they're at negative 6.88%. So again, that tells me that they burned off all of in the past month, they burned off all the gains that they've had. Because you look at the year to date, they're down 10.36. So again, the numbers look bad, but they're not as bad as what we're seeing in other areas. 1 year they're down 1.63%, but over 5 years they're up 63.73%. The stock market started at 2004, so there's a long history that they have in this operation. So basically, guys, we put this into our $10,000 budget program to where if we a year ago bought $10,000 worth of stock, it was at $20.24, would have bought us 494 shares. You go all the way down, I'm watching this, the numbers look great. And honestly, they look great all the way up to March 11th, where we were up 8%. And then we come into April, and this is where we get the kicker. We are now down to negative 1.63%. So 13-month returns are down 1.63%. But we were doing great up till that point with an 8% return. So it goes back to is you have to ask yourself, is it a economy issue or is it a operational issue? Well, operational wise, they're solid, doing great. It's a situation that a market, the stock market as a whole, is in turmoil. What did they do? And they're not dropping anywhere near what others have done. We take a look at the dividend return, and they're getting at 9.49%, 48 cents every quarter for $948. So a decent sized number. So when we take a look at their 12-month and 13-month returns, you're at 17.49% or 7.85%. So overall, I'm telling you, this is a great piece and probably one that we want to buy on this dip and changeover. When we look at the line chart that we go through, ARCC, again, I always call this one a mountain climber, is you're climbing to a peak of a mountain, you see something higher, so you got to go down to go up. So it just was climbing and climbing and climbing, steady growth all the way until we hit that March start drop off. And unfortunately, in March it dropped, and then in April it dropped dramatically. But the advantage to this in this dip in the change, the average price was $21.27. The current cost as of today is $19.91. That's 6% discount off of the average. And you got to look at the stock was well above that, $22.50, $23 a share just a few months ago. So I can tell you right now, I can already see this thing's probably going to have a good bounce back. It's going to have a real jump as the market starts to settle down with these tariffs and everything going on. So I see ARCC coming back very quickly off of this drop. So it really tells me it's a buyer's market for the dip. So is this good for a retirement account? And the answer is yes. We have it marked as a moderate buy, that this is one that we want to put some steady cash into. If you have money that's sitting in a money market account that's paying 4.5%, moving it to here, you've doubled your dividend payout every quarter. Okay, and you're turning around and you have a low growth, but those potential of more growth is coming around the corner. So as we say, 9.49 standard dividend gives you solid returns, and over the past month you had a steady 8.05% growth when the market is down 16%. So it's really, we got the Dow is down half as much as what you were gaining. So to me, this is really solid where you want to be. So guys, this is Doug, the Retirement Guy. I hope you liked the video. If you do, give us that thumbs up. It helps the channel. Don't miss any of our videos. These are trying times right now. We're trying to help you out as much as possible. Hit that subscribe button. And again, any comments, don't be afraid to put them down the bottom. We look at them all the time. Guys, thanks again, and we thank you for your support.